Hi guys, in my previous video I had promised to talk about how to choose shares in Kenya without buying it because of hype. And this is because when you go to the Nairobi Security Exchange platform, there are so many companies that are listed for you to choose where to buy shares. And most beginner investors find it difficult to choose a share because they do not know which one suits their financial goals. This is because the biggest mistake new investors make is not choosing the wrong share. It is choosing shares for the wrong reasons. If you're buying shares because everyone else is buying it, or a company because someone mentioned it, this video could save you an expensive mistake. So in this video, I will show you how to buy shares using simple principles that can help you to make better investment decisions. If this is your first time, welcome to Build Your Wealth Hub, where we talk about money and we simplify investments so that anyone can be able to understand and invest. We also offer personal finance coaching. You can check out our website at buildyourwealth.co.ke and book yourself a session. Also, please subscribe to our channel so that you don't miss the free videos on how you can build your wealth. If you're a returning subscriber, thank you so much for stopping by, and let's dive into the video. The first principle before you buy a share is know why you are buying from this specific company. Ask yourself, are you investing for long-term growth, for dividend income, for capital growth, for short-term trading? You know, there could be so many reasons why you are investing in a specific company. Your goal will determine what kind of shares you will be looking at. Some shares are good for dividends, others are good for long-term wealth, others are good for short-term trading. So all these factors will help you to pick the best share, which goes hand in hand with your financial goals. The second principle is don't buy because everyone else is buying. So you will hear so many people saying, I bought a share because a friend recommended, I saw it on TikTok, Facebook said so, or so many other things. I would advise that don't buy a share just because someone else bought it or someone else mentioned it, because popularity does not always mean value. I would suggest that you do your research, and before you invest in a company, be aware or be sure that that is what you really want, and it is not because someone else recommended it. Because again, it goes back to the first point that you and the person could be having different financial goals, so which means you will have to go for different companies. The third principle is understand the company. Take your time. Nowadays, you can go on Google and find the company's website. Ask yourself, what does the company do? How does it make money? Is the demand for its products likely to continue? Because remember, from the demand, they make profit. From the profit is where they pay you dividends. If the demand is not likely to continue, there is a likelihood that you won't have to be paid your dividends because the company won't be making any profits. So all this information is available on their websites, and you can do your due diligence, do research on these companies before you put your hard-earned money in them. Also, understand what the business does. If it is a banking sector, how does it make money? If it is a manufacturing sector, for example, they export tea leaves, how do they do that? So ask yourself. And if you do not understand how the company works, you are better not investing your money in it. The fourth principle is check the financial health of the company, and you do not need to be an accountant to do that, to check the financials of a company. Check things like their revenue trend, their profit trend, their debt levels, because always a company will prioritize paying back debts before paying dividends. So if the company has a very high debt, you are likely not to be paid dividends because it will have to pay back the debts. Check their revenue trend and generally the cash flow of the company before you buy their shares. All this again is available on the company's prospectus and it is on the website because this is a mandate that they need to publicize all these documents. So it is not something that you need, to contact them or anything. You just check online and you will find all this information. A company with growing profits over several years is usually more attractive than a company with declining performance. So you can use that as a baseline to choose what company you want to buy shares in. The other principle is the dividend history of the company. If you are investing for passive income, for example, this is very important. Check the company. Has it paid dividends consistently? Has it increased or decreased the amount of dividends? And can the company realistically continue paying dividends? Don't just buy from a company just because the dividend is high. Just try to look at the trend of the dividend history, if it has been increasing, declining, or remaining the same over years before you go for it, especially if you are interested in passive income. The other principle is, are the shares overpriced? A great company is not always the best investment if everyone has pushed the prices high. So sometimes patience is the best investment strategy. Just because the price of the share is too high does not mean that it is a great company. You can give it some few days and see when the price says go low, because again prices are volatile, then you can buy the shares. That way it will save you some money. You don't have to just buy because the prices look so high at the moment. And the last principle we are talking about today is diversify. Avoid putting all your money in one share or putting all your money in one sector. Diversify your money across different sectors like telecommunication sector, banking sector, manufacturing, energy, and agricultural sector, and so forth. So diversification will help you to reduce risks. When one company, for example, the banking sector is doing well, and maybe the manufacturing sector is not performing well, at least your portfolio will be balanced and will help you to stay afloat and to reduce risks. Remember that successful investing is not about buying the hottest share today. It is about buying quality businesses at reasonable prices and giving them time to grow. Do not let hype make your investment decisions. Instead, let research do that for you. If this video helped you in your investment journey, please give it a thumbs up and subscribe to Build Your Wealth Hub for more simple investment tips that are designed for beginners. And let me know in the comments, what's the first thing that you look at before you buy a share? Thanks for watching and I will see you next time. Bye.